Have you ever noticed how some companies can just casually raise their prices and you barely even blink?
Yeah, and then for other things, even a tiny price shift makes everyone like scramble for alternatives.
Exactly. What is it that makes us so, sensitive sometimes and other times completely immune?
It's a great question.
Well, today we're diving deep into a really powerful economic idea, price elasticity of demand, or PED for short.
Ah, yes. Crucial stuff.
It's basically the hidden force dictating how we, as consumers, react to those price changes. Super important for any business. Doesn't matter if they're selling, I don't know, software or chocolate bars.
Absolutely critical.
So our mission today, let's try to unpack the formula, look at some real-world examples, and maybe uncover the surprising factors that make demand for different products either, well, super flexible or incredibly stable.
Sounds like a plan. It touches on so many business decisions.
Before we get into the thick of it, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, and explanations we'll be talking about are derived from the comprehensive accounting resources over at farhatlectures.com.
Great resources there.
Definitely. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, do check out the website. They've got additional practice questions, video lectures, and lots of detailed support to help reinforce what we covered today. And a special thanks to Professor Farhat for providing this valuable material for our discussion.
Okay, let's do it.
All right, so price elasticity of demand. At its heart, PED is really all about measuring responsiveness, right?
Exactly. It puts a number on how much the quantity demanded of something, a product, a service, changes when its price goes up or down.
So it's like the consumer's flinch factor.
That's a good way to put it. Yeah. For any business owner, it answers those really fundamental high-stakes questions like, okay, if I raise my prices, am I going to lose a ton of customers?
Or the opposite, if I drop my prices, will I get enough new buyers to actually, make more money overall?
Precisely. It moves you past just guessing about how people will react. And for anyone familiar with, say, financial modeling or accounting, it's actually pretty similar to doing sensitivity analysis.
Ah, like in Excel doing those what-if scenarios.
Exactly that. You're asking, what happens if this input changes? In economics, when we focus specifically on price and quantity demand, we call it price elasticity of demand. It helps you see the ripple effects.
That makes sense. I remember Professor Farhat using his own lectures as an example. He'd ask, okay, if the subscription price went from, say, $29.99 up to $35, or maybe down to $25, how would you, the person thinking about subscribing, react?
Yeah.
Would you still sign up? Would more people sign up? Or would people leave?
Right. That's the core question PED helps quantify. How sensitive are you?
Okay, so how do we actually calculate this? Put a number on that flinch factor.
Well, the formula itself is pretty straightforward. It's the percentage change in the quantity people demand,
Okay.
divided by the percentage change in the price.
Percentage change in quantity over percentage change in price.
Got it. And calculating that percentage change, remember, it's always the final value minus the initial value, all divided by the initial value.
Right, that initial value is key.
It is. And one slightly tricky thing, price and quantity usually move in opposite directions, right? Price goes up, quantity demanded tends to go down.
Sure.
So the raw calculation often gives you a negative number, but for interpreting elasticity, we generally just use the absolute value. We ignore the minus sign.
Ah, okay. So we're focused on the size of the response, not the direction.
Exactly. Just how sensitive is it? That's the main thing we want to know from the number.
And that point about the initial value.
Yeah.
It's important, isn't it? Like, if something goes from $50 up to $60,
Okay, yeah.
that's what, a $10 increase on a $50 base? So a 20% increase.
Right.
But if it starts at $60 and drops to $50, it's still a $10 change, but the starting point is different.
It's a $10 decrease on a $60 base. So that's, let me think, 10 divided by 60, that's about 16.7% roughly.
See? Same $10 change, but the percentage is different. Really shows why that initial value matters in the formula.
Absolutely. Consistency there is key.
Okay, let's make this more concrete. Imagine a company, maybe Peak Performance Gear. They sell athletic stuff.
Okay, peak performance gear. I like it.
Let's say they have some really high-end running shoes, premium stuff.
Got it. Top tier shoes. Let's say they normally sell them for $200 a pair.
And at that price, they sell maybe 1,000 pairs a month.
Okay, $200, $1,000 pairs. Now, suppose Peak Performance decides to run a sale, drop the price to $180.
That's a $20 drop from $200, so a 10% price decrease.
Right. And let's say because of the sale, their sales jump quite a bit, maybe up to 1,500 pairs a month.
Wow, okay, so quantity went from 1,000 to 1,500. That's a 500 pair increase on the original 1,000. So a 50% increase in quantity demanded.
Exactly. So now we plug those into our formula. Percentage change in quantity
That was 50%,
divided by the percentage change in price.
which was 10%. But it was a decrease, so technically negative 10%.
Right. But remember, we usually take the absolute value. So 50% divided by 10%.
It gives us 5.
Yeah.
So the BED for these running shoes is 5. What does that number 5 actually tell peak performance gear?
A number greater than 1, like 5, means demand is elastic.
Elastic, meaning
Meaning consumers are very responsive to price changes for these shoes. That relatively small 10% price cut led to a much larger 50% jump in sales.
okay,
It suggests people have options. Maybe there are lots of other good running shoes out there, other brands.
substitutes.
Exactly, substitutes. So if Peak Performance tried to raise the price, they'd likely see a big drop in sales because people would just switch.
Makes sense for high-end shoes.
Yeah.
Now, what about another product? Maybe Peak Performance also sells some kind of specialized recovery supplement, your knee formula. Maybe doctors recommend it.
Okay, a different kind of product, less competition perhaps. Let's say these supplements usually sell for $50 a bottle.
And they sell, say, 2,000 bottles a month at that price.
All right. Now suppose Peak Performance decides to raise the price slightly, maybe to $55 a bottle.
Okay, that's a $5 increase on $50. So a 10% price increase this time.
Right. And let's imagine, despite the price hike, sales only dip a little bit, maybe down to 1,900 bottles.
So they lost 100 bottles from the original 2,000. That's 100 divided by 2,000. That's a 5% decrease in quantity.
Correct. So we calculate the PED again, percentage change in quantity,
5% decrease,
divided by the percentage change in price.
10% increase, again, using absolute values.
We get 5% divided by 10%, which equals 0.5.
Okay, 0.5, that's less than 1. What does that mean for the supplements?
A PED less than 1, like 0.5, signifies inelastic demand.
Inelastic, so the opposite of elastic.
Exactly. Consumers are not very responsive to price changes for these supplements. That 10% price increase only caused a small 5% drop in sales.
Why would that happen?
Well, it often happens with things people see as necessities or things with few good substitutes. If athletes feel they need this specific supplement for recovery and there isn't a great alternative,
They'll keep buying it, even if the price goes up a bit.
pretty much. This is often a good position for a business to be in because it gives them more pricing power.
Interesting. So the same company, Peak Performance Gear, has one elastic product, the shoes, and one inelastic product, the supplements.
It's very common for businesses to have a mix like that across their product lines.
So we know if it's elastic or inelastic,
Mhm.
but how does this connect directly to the bottom line? Total revenue.
That's the crucial link for business strategy. Let's break it down. If your PED is greater than one demand is elastic, like the running shoes.
Very responsive consumers.
Right. If you increase your price, your total revenue will actually fall because the drop in quantity sold will be proportionally bigger than your price hike. People will flee.
Okay, so raising prices on elastic goods is bad for revenue.
Generally, yes. But if you decrease your price, your total revenue will rise. The increase in quantity sold more than makes up for the lower price per item, like the shoe sale example.
Got it. Elastic, price up, revenue down. Price down, revenue up.
Exactly. Now, if your PED is less than one demand is inelastic, like the supplements.
Not very responsive consumers.
Correct. Here, if you increase your price, your total revenue will likely increase. The quantity sold drops, but only by a little bit, proportionally less than your price increase.
So you gain more from the higher price than you lose from the slightly lower volume.
Precisely. And conversely, if you decrease the price on an inelastic good, your total revenue will probably fall. You won't gain enough new customers to offset the lower price.
Inelastic. Price up, revenue up. Price down, revenue down. That's the sweet spot businesses often want, right?
It definitely offers more flexibility in pricing, yeah.
And what if it's exactly 1?
Unitary elastic. PED equals 1. This means the percentage change in quantity demanded is exactly the same as the percentage change in price.
So a 10% price increase leads to exactly a 10% quantity decrease.
Yep. And in that specific case, total revenue stays exactly the same. The price change and quantity change perfectly offset each other.
Wow. Understanding which category your product falls into seems absolutely critical for making smart pricing decisions.
It really is. It guides whether you should consider discounts or price hikes or just holding steady.
So we've defined PED, calculated it, seen the revenue impact with peak performance gear. But I'm still thinking about the why. What really causes demand for one thing to be super sensitive and another not? What are the underlying factors?
Yeah, that's digging a level deeper. There are several key factors that influence whether demand is elastic or inelastic. Probably the biggest one is the availability of substitutes.
We mentioned that with the shoes. Lots of alternatives.
Exactly. The more substitutes there are, the more elastic demand tends to be. Think about, say, brands of soda. If Coke raises its price, you can easily switch to Pepsi or store brands or something else entirely. Lots of choices make consumers price sensitive.
Okay, substitutes is number one. What else?
Next is necessity versus luxury, things we consider essential.
Like basic food, water, maybe essential medication.
Right. Those tend to have inelastic demand. You need them, so you're less likely to cut back drastically even if the price rises. Luxuries, on the other hand, a fancy watch, a high-end vacation.
Things you want but don't strictly need.
Precisely. Demand for those is usually more elastic. If the price goes up, you can easily postpone the purchase or just skip it. Peak performances supplements might lean towards necessity for serious athletes, making them inelastic.
Makes sense. Necessity versus luxury. What's third?
The time horizon. How much time do consumers have to react?
Oh, interesting. How does time play a role?
Well, in the short run, demand can often be quite inelastic. Think about gasoline prices jumping overnight.
You still have to drive to work tomorrow morning. You can't instantly change your habits.
Exactly. But in the long run, demand becomes more elastic. Given time, you might buy a more fuel-efficient car, or start using public transport, or find a carpool.
You find alternatives or ways to adjust your behavior.
Right. So time gives people the chance to find substitutes or change consumption patterns, making demand more elastic over longer periods.
Okay, substitutes, necessity, luxury, time horizon, any more.
Yep. Another important one is the proportion of income spent on the good.
How much of your budget it takes up.
Uh-huh. If something represents a large chunk of your income, think housing or buying a car, demand tends to be more elastic. Even a small percentage increase in price can be a significant amount of money, forcing you to react strongly.
Whereas if the price of, I don't know, a pack of gum doubles.
Right. It might be annoying, but it's such a tiny fraction of your overall spending that your demand probably won't change much. It's likely inelastic.
So big ticket items tend to be more elastic, small ticket items more inelastic.
Generally speaking, yes. And one more, which is really interesting for branding.
Okay.
Brand loyalty and habit.
Like people who only buy Apple products.
Well,
Or always get coffee from the same place every morning.
exactly that. Strong brand loyalty or deeply ingrained habits can make demand less elastic. These consumers are less sensitive to price changes because their preference or the routine outweighs the cost factor up to a point.
So peak performance gear, by building a strong brand, could actually make demand for its products less elastic over time.
That's often a key goal of branding and marketing, yes. To reduce price sensitivity by building that loyalty or habit.
Fascinating. So it's substitutes, necessity, time, income proportion, and loyalty or habit. Quite a few moving parts determining that final elasticity number.
It really is a mix of these factors for any given product or service.
Well, this has been quite the exploration. We've really unpacked how price elasticity of demand measures that consumer sensitivity. We saw how it's calculated, looked at peak performance gear, shoes versus supplements.
Yeah, the elastic versus inelastic scenarios.
And dug into those key factors, substitutes, necessity, time, budget share, and brand loyalty that really shape the whole thing.
Absolutely. And hopefully, knowing all this, you, the listener, can now look at pricing strategies out in the world with, well, a fresh perspective.
Right. You start seeing why some brands seem to always be running sales.
While others seem almost immune to price competition, it's often about the underlying elasticity they're dealing with, or maybe even trying to cultivate.
So maybe a final thought for everyone listening. Think about something you buy pretty regularly. Could be, I don't know, your streaming subscription, that morning coffee, your internet service.
Something you purchase often.
Based on everything we've talked about today, substitutes, necessity, habit, all that. Do you think your demand for that specific thing is elastic or inelastic or maybe even unitary elastic? And why?
Yeah. What factors make you more or less sensitive to its price? It's a good way to see these concepts play out in your own life.